Hi, everybody. Welcome back to Ox Talks. Thanks for watching the show today. Please like the videos. If you enjoy the content, hit the thumbs up button for me. Share the videos with people as far and wide as you possibly can. We'll keep waking folks up. And if you're not subscribed, please hit that subscribe button. It means a lot to me. We are growing the community and growing this channel. I would be remiss if I didn't address one issue today, and that is the explosive price action in silver. For all you silver bugs out there, last time I checked, silver was up about $2 troy ounce today. That's about over 6%. Gold's also up $27, $28 an ounce. So look, a lot of price action in silver. Leave your comment below if you guys like silver, if you own silver, physical silver, and what you think. There's a lot of analysts out there saying when we got to close over $32.50, over $32.50 close for silver sustained, right? It means for a few days that silver could be off to the races, making that run back to 50. Again, not trading advice, not economic advice or financial advice, but I've been reading that a lot lately, and we'll see if this holds. Now, the markets haven't closed today. Metals markets don't close for another hour and a half or so. Let's see if it holds these gains. A close on a Friday for silver, well over $33 an ounce right now, is not bad. And then let's see what next week would hold, okay? Hopefully it's not a head fake, but we shall see. So for the silver bugs out there, good day for you guys. That's some positive news. Let me get into an article that's not so positive and has to do with the credit card debt in this country. Discuss it all the time on this channel, but this is an article I saw from Zero Hedge today. It says increasing number of Americans getting trapped in credit card debt. Rising prices and higher interest rates are trapping many Americans in expensive credit card debt, a new report states. According to a survey released Thursday by Bankrate, a financial analytics firm, listen to this, 37% of American credit card holders have maxed out or nearly maxed out on their card limits since the Federal Reserve began raising rates in March of 2022. So that's probably higher than you would expect to see in an economy that has low and stable inflation. Bankrate analyst Sarah Foster told the Epoch Times. Sarah Foster says that's probably higher than you expect to see in an economy that has low and stable inflation. Okay, do you guys believe that we have low and stable inflation? I think this is just a sign that consumers are feeling some distress, and the nationwide aggregate numbers just might be masking what's underneath the hood. Okay, I would agree with this statement that consumers are feeling more than just some distress, but a massive amount of financial distress right now, trying to pay the higher prices for food, insurance, auto costs, medical costs. According to the survey, more than half of the respondents who had gone deep into credit card debt blamed inflation, which has reduced the value of the U.S. dollar by more than 20% since 2021. That's incredible. Inflation's reduced the value of the dollar, the purchasing power of your dollar, by 20% since 2021. And guess what started happening in 2021? The money creation machine was in full force and effect as the pandemic was unfolding. And this left many Americans struggling to afford basic necessities. The second reason, cited by 38% of respondents, was unexpected emergency expenses. Aggregate U.S. labor data are generally positive. Unemployment, while edging up slightly over the past years, remains low at 4.1% as of September, according to the Bureau of Labor Statistics. Again, the BLS. We've talked about that before on this channel. You have to take that with a grain of salt. Wage growth, while down from 2023, is 4.7% as of September, according to Fed statistics. So they're admitting here wage growth is down, inflation is up. Even if they say that it's tame. So your dollars are going, obviously, I'm preaching to the choir here, all of our dollars are going a lot less further than they used to. says, but national averages don't always capture the plight of those who are struggling. According to the Q4 2023 Quarterly Credit Industry Insights report released in February by TransUnion, a credit rating company, Americans' credit card debt exceeded $1 trillion for the first time on record and grew by 13% over the prior growth year. 13% growth, maxed out, highest rates. What are rates now on credit cards? 29, 30%, something like that. And by contrast, to more affluent Americans who can draw on options like home equity for cash, those who must resort to credit cards will typically pay interest rates of almost, it says 25%, according to the Lending Tree, a consumer finance company. Those high interest rates add to monthly card payments, making it even more difficult for those who have gone deeply into credit card debt to climb back out of it. Again, once you start going down that rabbit hole of credit card debt, unless you get a windfall, financial windfall, an inheritance or something like that, it is very, very difficult to dig your way out of that hole. And that's why what you're going to see is more defaults. You're already seeing 30, 60, 90 days late increasing. You're going to start seeing more just people walking away from those card balances and more bankruptcies across this country into later in this year into 2025 from my perspective. In addition, those who max out on credit cards also often see their credit scores decline, closing off other options to consolidate their debt at lower rates. According to Experian, a credit rating agency, a person's credit utilization ratio, or how much an individual has borrowed under available credit lines, comprises about 30% of a FICO credit score, a key measure used by banks and card companies to assess credit worthiness. Running up against card limits, it says, will often result in a substantial reduction of a person's FICO score. Lower FICO scores not only result in higher interest rates, but they can also drive up other costs like car insurance. People with poor credit pay on average $4,349 per year for a full coverage car insurance policy compared to $2,348 for those with good credit rating. Bank rate insurance analyst Shannon Martin told the Epoch Times, by comparison, a driver with a drunk driving arrest pays $4,557. So, just by having poor credit, without a DUI on your record, you're almost paying the same amount as somebody within $100, as somebody who has a DUI on their driving record. That is pretty insane. That is how much the FICO score matters and keeping your debt to limit ratio in check. Concerns about consumer spending. Given that consumer spending, it says, comprises more than 2/3 of America's GDP, indications of consumer distress can be a red flag for the economic health of the country. From an economic standpoint, it says, if we already have this many Americans struggling to handle inflation, they're tapping their credit cards and running out of options to finance essential expenses. That's a pretty worrisome sign for the economy too, according to Foster. We're in the fourth quarter now, and we're approaching a crucial holiday shopping season. Of course, all these retailers rely on the American public to go in there and swipe those cards during the holidays. They've already got Christmas stuff out, in the stores now, trying to lure in buyers when we haven't even, finished Halloween yet. Typically, she said, when people max out their credit cards, it also indicates they're likely behind on paying other bills such as heat, water, and electricity. An October report from Bankruptcy Watch found that, here we go, personal bankruptcy filings have increased significantly over the past 3 years. Chapter 7 filings, a lifeline for many struggling households, increased by 44.77% year over year. The report stated, also noting an unprecedented surge in Chapter 13 filings, which are filed by individuals who hope to hold on to essential assets like their homes and cars, and which increased more than 21% year over year. Those are pretty substantial numbers, ladies and gentlemen. While personal bankruptcy filings are trending upward, they're still well below pre-pandemic levels. Current trends in bankruptcy filings suggest a return to pre-pandemic levels. Analysts say that some of the recent increase in bankruptcies is due to the fact that government payments following COVID lockdowns have run out for many Americans. So, guys, that is the update on the credit card debt situation in this country. almost 40% of the American public is maxed out on their credit cards. Where is this? And that's because they've had unforeseen medical expenses. What happens if they've maxed out those cards and they have additional medical costs, medical emergencies? There's no way to pay for it, right? There's no more credit line available. Visa, MasterCard, Amex are shut down. Once you miss some payments, guess what? All the other credit card companies automatically will reduce your credit line to your outstanding balance. Okay, that will happen. It happened in 2008 to a lot of people. So that is the next shoe to drop. With that being said, I hope all of you have a great rest of your day today. That's not great news, but it is the reality of what's happening in this country. Whereas, again, look at the stock market today. You wouldn't know it, right? Because everybody's out there saying that things are fantastic. We know under the hood, so to speak, there's a lot of struggling people in this country. So those people should be kept in our prayers, and everyone do their best to minimize their debt, get themselves out of debt, and just don't make stupid decisions buying things that you really don't need if you can't afford it. Okay, I'll leave it there today. Went a little bit long, 11 minutes. Again, thank you for supporting the channel, subscribing, liking, and sharing. Talk to you all soon. Bye.